Good afternoon, everyone present here. I am CA Somdatta Raghu from Varanasi, the moderator for this webinar. We are delighted to welcome you all to this webinar, which is being organized by the Continuing Professional Education Committee of ICI. The CPE committee has organized a series of webinars for the benefit of members at large. It's going on from 6th of October 25 to 17th October 2025 from 12 p.m. to 2 p.m. daily. We request you to please block your
Religion,
calendars for the same,
South Forward.
17th October. It is my pleasure to be a moderator for the 54th webinar. I'm quite thankful to the chairman of the committee, CA Satish Kumar Gupta sir, and vice chairman, CA Vishnu Kumar Agrawal sir. The topic for today's webinar is Ind AS 16 and 20 and tax audit clauses 25, 29A and 29B. We have our eminent faculties present here who will deliberate on these topics from 12 p.m. to 2 p.m. In a short while, we will start this webinar. First, I would like to appraise you about the CPE committee. The role of as you all know, the role of a chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CAs depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. So the CPE committee also believes that members of ICAI should look beyond the traditional areas of practice, what we do in today's our practice area, and seek and explore new areas of business and profession. So the CPE committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, and it's also providing background materials, etc. And simultaneously, the we at CPE committee are encouraging young and dynamic professionals to grow as speakers, master of ceremonies, etc. So the program for this afternoon is as follows. We have two sessions of 1 hour each, and the topics are first is Ind AS 16 and 20, and the second session will be on tax audit is specific to the clauses 25, 29A and 29B. Our eminent speakers will talk about the above mentioned emerging areas of professional interest. So, starting from the technical session, I would like to read the biodata of our eminent vice chairman of the CPE committee, CA Vishnu Kumar Agrawal sir. In a brief, he is FCA and DISA. CA Vishnu Kumar Agrawal sir is a Central Council member of ICI for the term 25 to 29. He currently serves as the Vice Chairman of the CPE Committee and the Direct Tax Committee of the ICI. Additionally, he is an esteemed member of several other key committees of the ICI. With over 2 decades of experience, he specializes in income tax matters and has also authored the book titled Landmark Judgments of Income Tax. He has various social engagements and community involvements also. Beyond his professional commitments, CA Vishnu Kumar Agrawal sir is actively involved in social service and community initiatives. His professional acumen, leadership roles, and dedication to both the profession and society make him a respected figure in the accounting and taxation domain. I would like to welcome sir and invite him to give uh, his
Thank
word
you. Thank
enlightenment.
you, Raghuji. Respected today's moderator, Somdatta Raghuji. Today's speaker on the India's 16 and 20, our learned speaker from Jaipur, C. Harshit Jain ji, and Alok Modane ji on the tax audit closes on 25, 29A and 29B, and our chairman of the CP committee, C. S. Satish Gupta ji. Today is the absence here. I welcome all of you in today's webinar on the series of the India's and the tax audit close. Friends, I am also vice chairman of the direct tax committee. Before apprise the CP committee, just I want to highlight the what we are doing under the direct tax committee. Friends, just before only 20 days, we have came out with the Income Tax Act 2025. First time in the history of the direct tax committee, we have published the Direct Income Tax Act 2025 because we have thought that all the publication house is selling in 2000 rupees and 2500 rupees. And since this act has been changed, so my each and every member will be purchased from the publication house. So why not we from institute publish this income tax act? Then we have published this income tax act comparison with the old 1961 section along with the new act 2025 act. Friends, it is so I request each one of you, if you have not buy this income tax act 2025, purchase from the Institute of the Chartered Accountant of India with only rupees 500. Friends, at the same time we have came out with the revised guidance note on the tax audit. Since tax audit is going on, so I request each one of you, wherever you face any difficulty, please go through our revised guidance note 44AB. At the same time, friends, we have also came out with all the checklist of the ITR forms. So I request each one of you, wherever you face any type of the problem, you just take the help of our checklist of the ITR forms. Friends, in the CP committee, we have generated so many CP hours across the country, and my each and our main aim to reach to last corner of the member of the country. So we are trying it level best with my chairman Satish Gupta ji to reach out each and every member of the our institute. Friends, we are doing so many webinars under the CP committee, and we are also doing the series of the India's and the tax audit close from last so many days. So I request each one of you, because this tax audit is going on, so we thought that my each and every member must be benefited from this particular close with particular webinar. Friends, I will not take much of the time because we want to give the maximum time to Harshit Jain and Alok Modani ji. So I request our moderator Raghuji to first introduce our Harshit Jain ji for benefit of our all the members. Thank you, friends.
Thank you, Vishnu sir, the vice chairman of our CPE committee. Thank you for your words of wisdom and providing your welcome address to the participants. We are having participants from across the globe, and all are eager to hear our key speaker for today's first session. So, I will briefly introduce my first speaker on the topic of Ind AS 16 and 20. He's CA Harshit Jain sir from Jaipur. He is a chartered accountant with qualification including BCom, CCUAE, FAFD, CCIBC, CCFXTM, and CCCA, bringing strong multidisciplinary expertise. He holds certification in forensic audit and fraud detection, insolvency and bankruptcy code, concurrent audit, UAE taxation, and foreign exchange and treasury management. He had significant post-qualification experience in the capital in the areas of spatial monitoring of companies with exposure exceeding 250 crores. He has deep practical experience in forensic audit, financial review, and specialized monitoring assignments across industries. So we welcome CA Harshit Jain sir, our first key speaker of today's webinar. In the first hour, we will take up questions from participants at the end of this session. Welcome, Harshit sir.
Thank you so much, sir, for your introduction, for my introduction. And good afternoon, everyone. Am I audible?
You're audible, sir. You can continue.
A very warm welcome to all the respected members and fellow participants. It's a pleasure to be part of this 54th webinar organized by the Continuing Professional Education Committee of ICI. And we will be covering India's 16 and 20, and further Alok sir will be covering tax audit clauses. I extend my sincere greetings to Sir C.A. Satish Kumar Gupta, Chairman of CPE Committee. He is not here. And C.A. Vishnu Kumar Agarwal, Sir, Vice Chairman of the CPE Committee, and for their continued leadership and guidance. A very warm welcome to my co-speaker, C.A. Alok Modani, Sir, who will be covering the tax audit clauses, and to our moderator, C.A. Somdat Raghu, for coordinating today's session. In my session, I'll be covering India's 16 and India's 20, focusing on key concepts, practical insights, and challenges in implementation. My sincere thanks to ICI technical team for their seamless support in organizing this webinar. Thank you everyone for joining. I look forward to engaging an insightful session ahead. So I'll be sharing my screen. Yeah, is it visible? Starting from India 16, property, plant, and equipment. Our first point is that's applicability of this standard. So this standard is applicable on all the property, plant, and equipment except the following. First is non-current assets held for sale, which is separately covered under India's 105. Then biological assets, which is covered under India's 41. Then exploration and evaluation minerals assets, which are covered under India's 106, and mineral rights and mineral reserves, which is not covered under India's 60. So, second point is the scope of this India's. So scope covers recognition of property, plant, and equipment, its initial measurement and subsequent measurement. Third covers depreciation, impairment of PPE, which is separately covered under India's. So, our third point will be what assets can be categorized under PPE. So, PP is like the short form of property, plant, and equipment. I will be using this term. So, property, plant, and equipments are tangible items that are for administrative purpose held for more than a period, used to be in business to generate revenue. And so now comes part of the initial recognition of property, plant, and equipment. India 16 states that the cost of an item of property, plant, and equipment shall be recognized an asset only if these following two conditions are satisfied. First is it is probable that future economic benefit will flow to the entity, and the cost can be reliably measured. If any of the condition is not fulfilled, then we will not recognize PPEs as an asset. This recognition principle shall be applied to all costs at the time they are incurred, both initially and subsequently. So at the time of initial recognition, the purchase price and direct attributable costs are added to the cost of the asset, and in a subsequent recognition, any addition to the assets or replacement is also added to the asset. Initial measurement. Briefly talking about the initial measurement, an item of PPE that qualifies for recognition as an asset shall be measured at its cost. It should be noted that the cost we are paying to purchase an asset, it will be recognized on the cost basis, not on the market value or fair value basis. So the cost of an PPE comprises its purchase prices, including import duties paid, non-refundable taxes, and after deducting discounts and rebates. So it should be noted that only non-refundable purchase taxes are included in the cost of the assets. Second, any cost directly attributable to bringing the assets to the location and condition necessary for it to be capable of operating. So directly attributable cost, we can say installation cost for so that the PPE uh, uh, can be in a working condition. So that cost which will incur, which allows our assets to bring in a working condition, that cost can be added to the cost of the asset. Yeah, examples are also there. Transportation, cost of site preparation, professional fees, initial delivery, handling, installation, and assembly. These all are the directly attributable costs, which also becomes the part of the total cost of the assets. The initial estimate of the cost of dismantling and removing the items and restoring the site on which it is located. Okay. So it tells on the from the total value of assets, we will reduce this value of dismantling and removing the items. Then comes the next part, cost and cash price. The cost of an item of property, plant, and equipment is the cash price equivalent at the recognition date. Payment is recognized as interest over the period of credit unless such interest is capitalized in accordance with IS 23. If payment is deferred beyond normal credit terms, the difference between the cash price and equivalent and the total. Okay. So in this, uh, we will recognize the cost of PPE as the present value of all the cash flows which will be accrued during the coming periods. Barter exchange. So how will we recognize the cost of an asset if we acquired the PPE under barter exchange? If an asset is acquired in exchange for another non-monetary asset, the cost will be measured at the fair value. So initially, I've told you that we will recognize the PPE on the cost basis only. But in the case of barter exchange, we will recognize the PPE on the fair value. So unless the exchange transaction lacks commercial substance, or the fair value of neither of the assets received nor the assets given up is reliably measurable. So we will recognize on fair value only if these both conditions are not there. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given. Subsequent measurement after completing the initial measurement of the assets, we are coming to subsequent measurement. Often, property, plant, and equipments purchased for a longer period. They serve a long-term purpose, 5 years, 10 years, 15 years, more than that maybe. So during the tenure, these assets need some repairs, replacements, and additions. So day-to-day repairs will not become part of the total cost of the asset. As I have earlier mentioned, the two conditions should be fulfilled to recognize the asset. That first is future economic benefit should be flow to the entity, and cost can be reliably measured. So repairs and maintenance can never be a part of the cost of the asset. Replacements, if done, or additions, if done, will be the part of the asset. So an entity may choose two accounting models for its PP. Cost model, an entity shall carry an asset at its cost less accumulated depreciation and accumulated impairment loss. Then coming to revaluation model. An entity shall carry an asset at a relevant amount. Revalued amount is its fair value at the date of revaluation, less any subsequent accumulated depreciation and accumulated impairment loss. Okay, so measurement, the subsequent measurement can be done on both the basis cost model or the revaluation model. Revaluation. An entity shall revalue its asset with sufficient regularity so that the carrying amount does not differ materially from its fair value at the end of the reporting period. If an item of PPE is revalued, the entire class of PPE to which that asset belongs shall be revalued. So revaluation should be done periodically as per the asset. If the amount if the amount increases or decreases, we should accordingly value the assets in our balance sheet. So revaluation, initial recognition, subsequent measurement, revaluation, then comes to depreciation. Depreciation uh, is can be, yeah, depreciation is defined as the systematic allocation of the depreciable amount of an asset over its useful life. The items of PPE are usually depreciated in order to maintain natural principle. As they are in operation for more than a year, they assist in producing the revenues in more than 1 year, and therefore their cost shall be spread among those years in order to match the revenue they help to produce. So depreciation is by analyzing the life of the asset, we will reduce the value yearly so that the cost of the asset will be shown uh, in the coming period at par. That our property, that our asset will give if less tenure is there, so the initial cost shall be decreased, and it shows that how much asset is worth in the coming years. Okay, so initial cost. Impairment of assets is it's also done, but it is separately covered under India's statistics. Examples. I would like to add examples of costs that are not costs of an items of PPE that would not be the part of recognition. First, cost of opening a new facility like inauguration, cost of introducing a new product services like advertisement, promotional activities, cost of conducting business in a new location with a new class of customers, includes like staff training work given, admin expenses. So this type of expense will never be the part of the total cost of it. coming to the next India's 20 uh, definition is India's 20 accounting for government grants. So I'm from Jaipur, Rajasthan. Our state government is providing incentives in the form of RIPS scheme, Rajasthan Investment and Promotion Scheme. So I'll brief you in later. What India's 20 covers? The scope, definition, recognition, accounting, and disclosures. Introduction to India's 20 government grants. The government gives grants to entities for various purposes, including for industrial, geographic, and social development, to facilitate the flow of foreign investment, and to promote entrepreneurship as subsidies to reduce the prices of goods and services offered by these entities. So government grants for the benefit of the end consumer, and end consumer receive this benefit in the low cost of low purchase cost. So why India's 20 is required for accounting and recognition. So India's 20 is required for the appropriate treatment of the government grants in the books of accounts and proper disclosure in the financial statements. It also facilitates comparison with other entities and with prior periods, and to give true and fair results to the stakeholder of the reporting entity. So it's purpose of India's 20 is to recognition of the grants and for the proper disclosure in the financial statement. So coming to the scope part, India's 20 is applicable. The scope covers the accounting and disclosure as mentioned in the applicability part. What does it not cover? Non-applicability. The special problems arising in accounting for government grants and financial statements, reflecting the effects of changing prices or in the supplementary information of a similar nature. So, a change of a price is not covered. A change of a price due to government circular or government, like recently the GST has been reduced. So GST is reduced. It will not become a government grant. So it will not be covered in the financial statement. Second, government assistance that is provided for an entity in the form of benefits that are available in determining taxable profit or tax loss, or are determined or limited on the basis of income tax liability. If income tax holidays are provided, it will not be a part of the government grant. If government acquires the part of any company, any entity, will not be covered under government grant. And for agriculture specifically, India's 41 is there. So relating to agriculture grants, there is a separate India's 41. So definitions are given over here. Definition of government assistance, and what can be categorized under government grants. So government refers to the government agencies and similar bodies, local, national, or international, like our state bodies or central government. Government assistance is action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. Okay. Government assistance for the purpose of India's 20 does not include benefits provided only indirectly through action affecting general trading conditions, such as provision of the infrastructure in development areas or the imposition of trading constraints on competitors. Government grants are assistance by government. What are basically these government grants that we are talking about? It are the assistance given by the government in form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activity. So we have to understand this. What government grants are? Government grants are passing of resources from government to the entity with a condition that may be a past or a future condition, you know, the past or future compliances with certain conditions that covers our day-to-day operating activities of the entity. Grants can be of two types. Grants can be related to assets. Grants can be related to income. Grants related to assets are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Subsidiary condition may also be there. So, grants related to assets covers government may give a parcel of land, uh, give amount to construct a building, to purchase a property, plant, and equipment. So these grants are related to assets, by which our assets are increasing. And there is a second grant that is related to income. Basically, it is other than the grants related to assets. So how shall we recognize the government grant in our financial statements? Government grants shall be recognized at a fair value. Government grants, including non-monetary grants at fair value, should be recognized only when there is reasonable assurance that the entity will comply with the condition and the grant will be received. You have to focus here that there are two conditions to recognize the government grant. First, that the entity will comply with all the conditions related to that grant, and the grants will be received. Due to change in government, there may be a possibility that the grant you are expecting may not be received in the coming financial years. So these two major things have to be noticed, that we will comply with all the conditions attaching to them. That if the government gives a parcel of land and with the condition that you have to build a plant uh, for for employment purpose, to generate employment purpose. But but if the localites at the time of building the setup, if the localites objects that that industry, that plant is polluting our area, so they will object. So the purpose of employment is defeated. If the localites are not happy, they will not be taking employment in this newly built setup. So in this case, we will not recognize the grant, as entity will not be complying the conditions attaching to them. Okay. So two conditions shall be fulfilled. That entity will comply with the condition and the grant are certain that it will be received. A government grant is not recognized until there is a reasonable assurance that the entity will comply with the condition attaching to it, and then the grant will be received. Receipt of a grant does not itself provide conclusive evidence that the conditions attaching to the grant has been or will be fulfilled. So if an entity receives the grant, okay, so it will not automatically be adjusted as a government grant, since some future past or future conditions may be there which company have to comply. So at the time of receiving of grant, we will not recognize the total amount of the grant, in our financial statements, we have to check the compliances. We have to check that we have to recognize the grant in the current year or over the years. If we are benefiting from the grant for the coming 10 years, then we will recognize the grant in proportionately in 10 years. Okay. Then, third, then covers accounting of government grant. Two approaches are there: capital approach and income approach. Okay. Examples are also there. That A Limited, the entity, received the grant of rupees 10 lakh for purchasing machinery and for processing raw cashew nuts to finished cashew. The cost of the original cost is 30 lakhs and have an estimated useful life of 5 years, appreciation 10%. So the entity received a cash grant of rupees 10 lakh. Okay. So two approaches are there. First is capital approach, that we will recognize the machinery on the net value. The total cost is 30 lakhs. Government has paid us 10 lakhs. And so net outflow from the entity is 20 lakhs. So what we can do is we can measure the asset by the capital approach. Simply machinery on account debit for rupees 20 lakhs and our outflow to bank 20 lakhs. And we will recognize on the estimated life of 5 years. So 20 lakhs divided by 5 to 4 lakhs for the coming 5 years. We can do this. Or we can follow the income approach. In this approach, the assets will be valued at the fair value, original cost value, and amount of government grant shall be transferred to P&L account over the useful life of the asset. So in income approach, if we are benefiting for let's say 10 years, for in this example 5 years are there. In this example 5 years is there. So what we can do is recognize the grant in a P&L account. So the total grant is 10 lakh rupees. So each year we will recognize 2 lakh in our P&L account. So by passing initial entry, the total machinery cost will be of rupees 30 lakhs. We will recognize machinery at 30 lakhs. Our outflow is 20 lakhs. So to bank account at 20 lakhs and to deferred government grant 10 lakhs. So if the deferred government grant ledger will be created in the liability part, and each year for coming 5 years, we will recognize proportionately deferred government grant to P&L account like that. So coming to the next part, whether receipt basis of accounting is permissible. Recognition of government grant in P&L or a receipt basis is not in accordance with the accrual accounting assumption and would be acceptable only if no basis existed for allocating a grant to periods other than the one in which it was received. So they're telling us that we can't just recognize the grant in the P&L when it is received. We have to recognize the grant over the periods we are benefiting. Then comes accounting of grants related to non-depreciable assets. Previously, in this machinery example, we are recognizing the grant of a depreciable asset, that is machinery, which has a useful life of 5 years. And now comes to the recognition of grant related to non-depreciable asset. Non-depreciable asset majorly is land. So how we can account for land received by the government. So grants related to non-depreciable assets may also require the fulfillment of certain obligations and would then be recognized in a profit and loss over the periods that bear the cost of meeting of obligations. So in this para, they are also saying that in the non-depreciable asset, recognize uh, we can recognize the grant over the period for which the entity is benefiting. An example is also there. A grant of land may be a conditional upon the erection of a building. If we construct a build on the site, and it may be appropriate to recognize the grant in the P&L on the useful life of the building. So after purchasing after taking the land as a grant, we can recognize this grant over the useful life of a building, as we cannot as we cannot measure the useful life of the land, so we will recognize the grant on the useful life of a building. And accounting of grant for expenses or losses already incurred and grant as an immediate government grant that becomes receivable as compensation for expense or losses already incurred and for the purpose of giving immediate financial support to the entity with no future related costs should be recognized in P&L. So in this, we will understand that in this case only we will recognize the grant in directly to the P&L account for the current year. So this grant received will not is not conditional. It will not benefit for the coming years. This grant is for the relief or compensation that had been already incurred and to support the immediate financial system of the entity. So if this type of grant is received, then we will recognize directly in the P&L account. When accounting of forgivable loans and loans at less than market rate. So how do we account for loans that are forgiven by the government? For example, if government at the time of COVID, COVID also, no, COVID will not be the example. If government specifically forgive your loans or they provide subsidies on the interest rate, you are providing loans at less than market rate, then it will be covered in a government grant and we have to account for it. The benefit of a government loan at a below market rate of interest is treated as government grant. Below market rate uh, loans provided by a bank and subsidized by the government. So the entity is benefiting from it. It will be covered under the government. The loan should be recognized and measured according to India's 109 financial standards. The benefit of the below market rate of interest should be measured as the difference between initial carrying value of the loan determined in accordance with India's 109 and the proceeds received. So they are telling that in case we are getting the subsidized loans, so initial carrying amount will be determined under India's 109 and the difference between the carrying value and the total proceeds will be that difference will be the grant that we will be recognizing over the years. Okay. Uh, I'll also share a live example of these government grants. So I'm from Jaipur, Rajasthan, and our government, Rajasthan government, is providing these grants in the case of uh, in this RIPS scheme, that is Rajasthan Investment and Promotion Scheme. as mentioned earlier. In this scheme, they provide capital subsidy to 50% of the total value of the plant and machinery. Then they provide interest subsidy if of up to 6 to 7% of the total loan amount. We are providing tax subsidy. So if output tax liability, 50% of the output tax liability is covered under this subsidy. Electricity duty for 7 years is waived off. Registry charges are waived off. So this can be the part of the government loan. Uh, Last 15 minutes are also there, but I've completed them by. For any queries, we can just have a quick session. If not, I would like to close this. I would like to close my session.
Thank you, Harshit sir. Thank you very much for your deliberation. You have well covered the topic on Ind AS. Ind AS 60 was for property, plant and equipments, and Ind AS 20 was for accounting of government grants. It was beautiful deliberation by you.
Thank you, sir. It's my first time, and if given a chance, I'll well prepare for the next time. Make sure that it would be more interactive.
Your presentation was very good, and your slides were also very informative. And as of now, we don't have any questions. No? As I can see, there are no questions from any participants, so we may skip this question and answer session. And in between, if you want, you can readdress some issue if you like it. If you felt that in your presentation something or some slide was there which wants some extra attention of participants, then you can carry on for 5 minutes. We have time.
Just let me go through.
If you think so, for
I
the
think
benefit
I've
of our
covered.
participants.
I think I've covered majority of the part. So I will not add anything. Thank you.
Okay. Thank you, Harshit sir, and thank you all the participants across the globe. We are not only having participants from India, we are having some out station and out of the country participants also here with us. And as we have completed this first session on a topic was for Ind AS. Now we are going ahead to start with our second technical session, which will cover topics on tax audit. It will be deliberated by our learned key speaker, CA Alok Modani sir. He is also from Jaipur. Modani sir, welcome. Welcome to the dais. And
Thank you so much, Raghuji sir. Thank you so much.
before you may start your technical session, I would like to get your permission to give a brief introduction of yours, good self.
Please, for no permission, sir, you have.
CA Alok Modani ji is a qualified chartered accountant associated with his firm for over 22 years. possessing extensive experience in taxation, legal compliances, and audit services. He specializes in tax planning strategies for individuals and businesses, focusing on minimizing tax liabilities while ensuring full compliance with applicable laws and regulations. He is actively engaged in tax litigation, handling responses to tax notices, TDS and penalty proceedings, compounding matters, scrutiny assessments, and appeals before tax authorities. He also manages statutory and tax audits, preparation of MIS and financial reports, and ensures compliance with accounting standards and legal frameworks, which includes company law, labor law, and other regulatory requirements. Today, he is giving his lecture on the topic of on tax audit specific to the clauses 25, 29A, and 29B. And all related clauses are also will be covered, na? Alok sir?
जी सर जी सर
Okay. Then we welcome our key speaker for second technical session, Alok Modani ji. Sir, please.
नमस्कार a very good day to all of you. Respected Shri Satish Gupta ji, Chairman CP Committee, Vice Chairman Shri Vishnu Kumar Agrawal, और Moderator C. Raghu ji, and another speaker Mr. Harshit Jain. It's a pleasant moment that CP Committee has invited to me to present the clauses on tax audits. Now I am trying to explain both clauses. First, I will cover clause number 29A and 29B. Please. Is it viewable? Okay, thanks. So, first clause is 29A, which presents reporting of income under section 56 to 9. This clause presents that any sum of money received as an advance or otherwise in the course of negotiations for the transfer of a capital assets, if such sum is forfeited and negotiation do not result in the transfer of such assets, shall be chargeable to income tax under the head income from other sources. Means in the see where in cases some amount has been received and the deal has not been concluded or materialized, we have to show this amount in the income from other sources, not in the income from business and professions. For income tax purpose, negotiations for transfer are considered to have started once parties interact for the sale or transfer of the capital assets. Even if an agreement has been not materialized or registered and the transaction has yet to be completed, see if the advance are received and later forfeited due to the failure of the negotiation, the amount is to be disclosed under the head income from other source by section 56 to 10. In this clause, 56 to 9. So see, if there is a requirement, then we have to disclose the nature of income and along with the amount involved in the transaction. We can take an example that if a Mr. A owned a plot and he is entered into agreement to sell this plot with Mr. B and he has received a sum of rupees 10 lakhs as advances, but the deal cannot be materialized. So Mr. A has forfeited the amount on 13th March 2025. In this case, the total amount of rupees 10 lakhs will have to disclose under income from other source, and the tax auditor should report this amount along with the nature of transaction in related clause. Earlier, this section has applied with effect from 1st April 2014. Earlier, there was another section 51, which represents that the if amount received as advance and it is forfeited, it was required to be deducted from the cost of assets in the year in which the sale actually conclude of the property. Say if the amount is received in the financial year 8-9 and amount has been forfeited and the sale was done in the financial year 12-13, then this 10 lakh rupees was required to be deducted from the cost of that assets, and should be the time gap of 5-6 years. So the purpose of and the object of this section was to take the effect of this income on this year, on the same year in which the amount was forfeited. So the auditor should duly verify all the documents, all the agreements, so that it can be cross-verified, cross-checked that the amount is really related to the forfeiture of the amount. So auditor must taken the management representations. He has to verify all the agreements. He has to review sale agreement, development agreements, and he can also taken the third party confirmation that the amount has duly forfeited by the same. Next, he has to cover all the transactions which are reflected in the financial books of accounts. If any transaction is reflected in personal books of any assessee and auditor is not doing the audit of that books of accounts, he is not required to disclose that amount in the government CCD. See, although one more clause, there are some red flags for the auditor. If the advance is related to the business, say stock and trade, in such a cases, income may fall under business income or not. Section 56(2)(9) will not be covered in this situation. So all the business transaction like stock and trade will require to be reported under the business head, and the income, the clause income from other source will not be applied in such cases. There are some connected sections. First, section 56(2)(10), which indicates that the taxability of the forfeited advance received from transfer of assets should be reported. Section 51, which I have already explained, that before the year 2014, the amount required to be forfeited amount required to be reduced from the cost of acquisition of assets. Auditor also required to check that the transactions are duly covered under section 214, being capital assets. If the assets is not a capital assets, there is no need to disclose this amount in this clause. Also, there is a section 145, which explains the method of accounting, that the audit is that the assessee is maintaining his accounts on the basis of accrual basis or receipt basis. Section 44AB, which has already we have considered. One more clause, 29A, which represents that where any amount is to be included as income chargeable under the head income from other source, as referred in section 56(2)(9). If the answer of the auditor is yes, then auditor is required to represent the nature of income and the amount which is required to be reported under this clause. Say advance money is received 10 lakh rupees and it is forfeited, the auditor must report the 10 lakh rupees in the form number 3CD in relevant clause. Another important thing, if there is there is a lag on the part of assessee on the tax auditor, the section 271J shall be applicable, and the department can impose a penalty of rupees 10,000 rupees for wrong reporting. And similarly, ICAI can also take the disciplinary action on this end. Therefore, the auditor must obtain adequate documentary evidences, and he has to ensure that forfeiture is final and not undisputed. One more thing which I already covered, that the auditor is required.
Sir, your voice is not coming.
Oh,
Okay.
now it's okay?
Yeah, it's okay.
Yeah, sure, please. Yes, sir. Another clause is clause number 29B, which says that reporting under section 56 to clause number 10. This clause cover income arising from receipt of money or property, whether property is movable or property is movable, which is without consideration or which is in the inadequate consideration, commonly known as the deemed gift, taxable under section 56 to 10. Section 56 to 10 was introduced by the Finance Act 2017 to consolidate the widening of the scope of the earlier provisions. It provides that where any person receives money, immovable property, or movable property like shares, jewelry, etc., without consideration or for any inadequate consideration, and the value which exceeds rupees 50,000, the excess amount shall be charged to the income under the head of income from other sources. If there is a requirement that the assessee that the transaction is covered, then he has to show the nature of income and amount involved. An auditor should disclose under relevant clause. This clause cover income arising from the receipt of money or property without consideration, which I have already explained. Now, following are the transaction which will be covered under section 56 to 10. First, sum of money received without consideration from 1 or more percent and aggregate. If the aggregate is the exceed rupees 50,000, then entire amount will be taxable under the head income from other source, and auditor must disclose in the relevant clause. If the transaction is related to immovable property, which is without the consideration, and stamp duty value is excess of rupees 50,000 rupees, that entire stamp duty value will be covered under the head income from other source, and auditor should disclose under relevant clause 29B. In other cases, we will explain that if the consideration is less than the stamp duty value and differences is 50,000 rupees or 10% of the consideration, then difference of the stamp duty value and consideration shall be taxable. Which means there is a capping of 10%. Say we can take example, if that sale value is rupees 10 lakh rupees, and transaction and the circle rate of the property is 12 lakh rupees, then an entire amount of rupees 2 lakh, difference of 2 lakh rupees shall be considered. We can take example number 2, where immovable property for Indian consideration, Mr. B purchases land from Mr. C for rupees 8 lakhs. and the stamp duty value of the land is 9,20,000 rupees. Then see, there is a difference of 1,20,000 rupees, which is beyond the 10%. So the entire amount, 1,20,000 rupees, is required to be reported under clause 29B, since this transaction is covered under section 56 to 10. Now we will see the transaction of movable properties. If the transaction is without the consideration, the same treatment will be done, and the transaction is difference is the fair market value is rupees 50,000 or more. The entire amount is required to be reported under the head income from other sources. The transaction is related to inadequate consideration, and difference is rupees 50,000 or more. The difference amount is required to be reported under clause number 29B in the appropriate clause section. There are some transactions, here some situation where clause number 56 to 10 is not applicable if the amount is related from the relatives. Section 56 defines a number of relatives. If the transaction is done between these related parties, then the amount is not required to be reported under this clause and will not be taxable in income from other sources. Second, if the transaction is occurred during and on the occasion of marriage of individual, entire amount will not be taxable. And auditor is not required to report this transaction under clause number 29B. Third situation, where this amount is received under any will or by way of inheritance, no required to report this transaction in the form number 29 in the clause number 29B, and entire amount will be tax free. In contemplation of the death of the payer or donor, same clause will be applicable. If the amount is given by the local authorities, which is defined under section 1020, the transaction will be exempted. If some specified charitable education institutions which are registered under section 1023C or 12A, 12AA, 12B, then the amount is given by that charitable trust, the amount shall not be covered under this clause. Another, if the transaction are required, the transaction are covered under section 47, there will not be requirement to reporting these transactions. And one clause which was enacted by the Finance Act 2022 during the COVID situation, various payments were be given to the members and the family members of the persons who is suffering the COVID. This transaction was also exempted from section 56 to 10. Some connected sections and rules. Auditor, in case of transactions related to share value shares, then the auditor must take the certificate which are prepared under Rule 11U and 11UA, and he should calculate the fair market value. Then he can estimate that the transactions are required to be reported or not. One more section 50C, which explain the DAC value, a circle rate of the property, which is special provision for determining the full value of consideration in case of immovable properties. The auditor must require to disclose all the transaction under the clause number 29B of section G, which cover to be reported under form number 3CD. We can take example number 3, where some unquoted shares for less than fair market value. If the company X issues 1,000 shares at a rate of rupees 100 rupees, then total fair market value of the transaction is 1 lakh rupees. Total transaction value is 1 lakh rupees. However, the fair market value as per Rule 11 UA is 1,70,000 rupees. Then there is a difference of rupees 70,000 rupees, which is exceed 50,000 rupees. Therefore, all the amount of 70,000 rupees is required to be reported in clause number 29B, and it should be taxable under income from other sources in the hand of buyer. Now we are covering audit procedure and auditor's responsibilities. First, auditor should understand the nature of receipts. If the receipts is in the nature of parcel receipts, there is no requirement to disclose this amount. Auditor must obtain a list of all receipts of the money or property, whether movable or immovable, during the year, not arising from the regular business activity, and management list of the confirmation he should take. Second, he should review all the agreements and documents. He should review sale deed, share transfer form, purchase invoices, and gift deed. He should verify the valuation report, which I already explained. Immovable property transactions. If the transaction compare the transaction value with the stamp duty value, where the difference is more than rupees 50,000 rupees or 10% of the consideration, then this report should be given in relevant clause 29B. Audit should also check the exemption clauses, that if the transactions between the related party and the transactions occurred on the time of marriage or it is related to inheritance or will, the clause shall not be applicable. He should duly taken the management representation and duly kept in the filing in audit file so that it can be explained. He should ensure proper disclosure, check that such taxable receipts, if any, are correctly credited under the income from other source. He should duly undertake the religious scrutiny. Points of caution. Gifts or advance from unrelated party not supported by the documents and purchase of property below stamp duty value. These 2 points must be taken care during the time of audit. If the transaction is related to unrelated parties, auditor duly check and he should verify all the documents. He should also take the valuation report of the shares. Entries recorded in personal books but omitted from the business books is out of the audit scope and this was not required to disclose in clause number 29B. Now this is the reporting requirement where any amount is to be included in the income chargeable under the income from other source. Auditor should disclose this. If there is no requirement, there is no reporting will be done. And if there is a requirement for reporting, he should duly disclose the nature of income and amount. Say in the example we have taken. In the example, we have Mr. X A received a rupees 80,000 rupees from unrelated party. This reporting should be done. Gift of unquoted shares received at the value below fair market value and the differences between the stamp duty value and consideration of immovable property. All the transactions should be reported with relevant amounts. One more here, he should take that section 271J is applied, then 10,000 rupees per is there. In institute can take the code of ethics. If there is some question answer, we can take.
Sir, there's a question that can you please give some brief overview about clause 22(1), which is about interest payable for delayed period.
MSME.
Assessee has not provided nor paid interest, then what the auditor should write down there?
Sir, in this case, the amount will be added in the clause, and that will be added in the composition of total income, and the interest amount will not be allowed as expenditure. Even there is some delay in the payment to MSME enterprises, it will be considered as a default of section 43B and will be added in the computation of total income.
It's okay, but the question is actually if assessee has not provided any information to the tax auditor, then what we should write there?
The auditor should take a management representative letter from the assessee, because although he can take the MSME registration and he can conclude a third party evidence, he can directly call to the party that you are covered under MSME or not. I think that will be better.
Okay, please carry on.
Yes, sir. Sir, auditor should take a list of the supplier covered under the MSME Act. He can take the MSME number, MSME registration number, Udyam credit number. Also, he can verify the payment terms and actual payment dates. He should calculate the period of delay, and he can determine whether any interest is payable under section 16 or not. Report of that amount is required to be reported under clause number 21B. 29D, sorry, 21D. Now I am going to explain the clause number 25, which is related to section 41. There are some transactions which are required to be reported under this clause. Clause number 25 of the Form 3CD under section 44AB of the Income Tax Act require the tax auditor to report any amount of the profit chargeable to tax under section 41. Section 41 is designed to prevent an assessee from enjoying a double benefit. First, by claiming a deduction or allowances in the earlier years, and later by retaining or recovering the amount so allowed. In essence, section 41 deems certain receipts as benefit as business income of the year in which such benefit or recovery arises, irrespective of the whether the business continued to exist. It means that if a person has right of any amount in financial year 20 to 23, and let us assume that the amount has been received in financial 24-25, he should disclose this amount under section 41 in the year which this amount has been received. But if the business has been seized, the business is discontinued, then if the amount received even after, it should be disclosed and should be taxable under the head business income. Objective of section 41. To recapture earlier deduction or allowances that have turned into the income in the later years. Second, to ensure fairness in taxation by taxing recoveries, write back, or benefits related to earlier business expenses or losses, and to treat such gains as profit and gain of the business or profession even the business has ceased, which I have already explained. There are some scope of the coverage of section 41. 41(1), section 1 says remission or cessation of trading liability, recovery of expenditure or losses previously allowed. Then, if the amount has been received, the amount of benefit obtained or liability written off shall be taxable. That's section 41. Because section 36(1)(7) allows to the assessee to take the benefit of the amount which has not been received to the assessee. Section 41, subsection 2 explains sale and disposal of depreciable assets, which can be considered as balancing charges. If the sale values exceed the WDV, then the amount should be taxable under should be disclosed under head business and profession. But if it exceeds the cost of the assets, then it should be disclosed under the capital gain income. Section 41(3) explains the sale of scientific research assets. If the person is carrying on the business of scientific research and the assets has been, he's already taken the benefit of Section 35 when he purchased assets. In this case, excess amount of sale plus deduction already allowed minus cost, which is required to be reported under the clause 41 under section 41(3) and is clause number 25. Section 41(4) explains the recovery of bad debts which has already been written off, and in the next year if the amount has been received from the party, he should duly disclose this amount and duly disclose his amount in the Business Act under 41(4). Relevant clause 25. In section 41(4)(a), if some financial institution, if they keep some special reserve which is allowed under section 36(1), subsection 8, and if these financial institutions receive any amount or withdraw any amount from such reserve surpluses, then this amount is also required to be reported under clause 25, which covered under section 41(4)(a). We can take an example. When an assessee obtained any benefit in respect of trading liability or earlier allowed expenditure by a waiver or refund or return back, the value of such benefit is taxable as business income. Say Alpha Limited has claimed a 2 lakh rupees, which was the expenses payable to its supplier in the financial year 2023, and in financial year 24-25, the suppliers waive rupees 50,000 rupees
Sir, you can continue.
I'm sorry, I think there's some net connectivity issue. Please hold on, sir.
Sir, if you wish, you can turn off the camera
Okay.
and continue with the slide.
Okay. So I am asking, I am taking example. If Messrs Alpha Company and Limited Company claimed a rupees 2 lakh rupees was payable to supplier, and in the financial 2024-25, supplier waived rupees 50,000 rupees, then amount of rupees 50,000 rupees shall be taxable under the head business income, and auditors required to be reported this amount in clause number 25. Even I was saying that if a partnership fund has been dissolved, and after dissolution of the partnership fund, if partner received any amount on account of amount earlier written off, the amount received to the partner shall be taxable under the head business income. Clause number 41(2) subsection balance charging on the sale of depreciable assets. See, if the machinery cost was rupees 10 lakh and WDV was rupees 6 lakh and assets sold for 8 lakh rupees, then the amount which is beyond the WDV value, 2 lakh rupees, is required to be reported under clause 25, which will be covered under section 41(2). If sale proceed exceed the original cost, the balance to be taxable under the head capital gain under section 50. Now section 41(3). If any scientific research institutions sell any assets, the assets cost has already been deducted, the claim has been deducted under section 35, and the scientific equipment cost was rupees 5 lakh rupees. If assessee sold that assets for rupees 1,50,000 rupees, the entire amount of rupees 1,50,000 shall be taxable under section 41(3). Section 41(4), recovery of bad debts. When any amount has been written off as bad debts and the same is recovered in subsequent years, the auditor is required to be tax pay the tax on that recovered amount in the head business income. If a debt of rupees 1 lakh written off in the financial 22-23 and amount of rupees 40,000 is recovered in the financial year 24-25, then entire amount of 40,000 rupees shall be taxable under section 41(4). Next, section 41(4)(a), withdrawal from the special reserve. Where an amount from a special reserve created under section 30(1)(6)(1)(7)(8) is withdrawn, the withdrawal amount is taxable under the business income. Say if a housing company withdraw rupees 5 lakh rupees from a special reserve, the amount shall be taxable under section 41(4)(a) and required to be reported by auditor in clause number 25. There is a reporting requirement, say liability return back under section 41(1), sale of machine which is exceeding the value, recovery of bad debts. So there is a format of representation which tax auditor is required to be reported. Audit procedure under clause 25. The auditor must carefully verify the report and income chargeable under section 41. He should duly verify the books of accounts. He should proper scrutinize the sundry creditors and outstanding liabilities. If there is any suspense account or any account in the name of miscellaneous income, he should very careful. Bad debts accounts, he can check assets disposable and the sale of fixed assets. He should inspect all journal entries where liability are written back, and he should verify correspondence with the creditors and debtors. He can take the third party evidence as well. Scrutiny of supporting documents. He should examine the credit notes, settlement letters, refund vouchers, and bank statement to scrutinize the matters. And also he should cross-check fixed asset register for sale, disposal, or destruction of the assets. He should also confirm whether any scientific research assets or special reserve has been liquidated or withdrawn. All the things should be covered under management representation as well. Now, analytical review. Auditor should compare other income and miscellaneous receipts with previous years to detect any abnormal items. Like he should ensure that income and income from discontinued business has not been escaped as tax. He should verify that set of losses under section 41(5) is correctly applied wherever it's applicable. He should duly take the documents which is required to be kept in the audit file. The auditor should document the nature of the transactions giving rise to income under section 41. He should compute the amount and verify the calculation. Evidence examined. He should duly check waiver letters, recovery statements, etc. and management information letter is to duly taken. Now, tax liability and treatment. All the amount deemed income under section 41 are taxable under the head business and profession. Taxable in the year in which the benefit, recovery, or remission arise. Even if the business has ceased to be exist, such income is taxable under section 41. And set off of the business losses, non-speculative, other than non-speculative, from the year of cessation is allowed against such income. Reporting in the form number 3CD, clause number 25. This is the format which auditor should report the nature of amount which is report, say liability written back by the supplier, under section 41, profit on sale of machinery and recovery of bad debts. I have taken 3 examples. So description of the transaction and amount chargeable should be reported, duly reported in the clause 25. Conclusion. So, section 41 ensure equitable taxation by the taxed benefits, recoveries, and reversal of the deductions that were once allowed. Clause 25 from level 3CD requires the tax auditor to exercise due diligence in identifying the reporting such item. Proper compliances prevents understatement of income and ensure transparency and integrity in the reporting.
Thank you, Alok sir, for such a nice deliberation.
This was my first
Your
presentation. And
presentation
that,
was very insightful.
thank you so much, sir.
So we
Yes,
are
sir.
around the corner and it's going to be end of our today's webinar, which covered two different topics on Ind AS and tax audit. So, Achal sir, should we conclude or
Uh, yes, sir. We can conclude if there are no questions.
okay?
That's not a concern.
As
And
I can
we can
see,
check with Harshit sir if he would like to answer, like, or maybe sum up, or Raghu sir would like.
so as I can
I mean,
see, there are
Alok
no
Modani sir.
such questions for any of our speakers. There's one question I can see, but it's I'm unable to understand whether it's related to Ind AS or tax audit, actually.
Sir, Harshit sir is also available as of now. So
Hmm.
maybe if you can just read out the question.
The question is after forfeiture on further negotiations, if the forfeiture decision is reversed, what will happen? I think it's related to property, plant, and equipment, but it may be about tax audit point number 29 and 29B. As Alok Modani sir also covered, na, ki if there is a difference in stamp duty value and consideration value.
Yes, sir. If the difference is more than 10%, then the entire amount is required to be reported to the auditors, and it will be taxable under the head business and profession, sir.
Mhm.
Yes, sir.
Okay. So, Harshit sir.
Sure, sir. We can like and conclude the session here.
Okay. So first, I would like to thank all the participants without whom we cannot arrange these webinars, and for whom benefit we are doing it from the Continuing Professional Educational Committee. And I would like to thank our chairman of the CPE committee, CA Satish Kumar Gupta sir, in absentia, and CA Vishnu Kumar Agrawal sir, vice chairman, in absentia. And then I would like to thank our key speakers for today's webinar, for CA Harshit Jain ji and CA Alok Modani ji. Both are from Jaipur. And I would like to thank our technical support team and CP Secretariat. Uh, uh, please, as I said in starting, that please block your dates and time for this week until 17th of October for getting daily update on some knowledge sharing from CPE between 12 p.m. to 2 p.m. And there is a theme of series. So, thanking you once again. We are signing off and thank
Thank you so much,
Thank you
sir.
very much.
CP committee would like to thank both our faculties for today. And Manish, we can end the session here. Yeah. Thank you so much.